What is up, YouTube? This is Mentorship Monday. If you guys want to be a guest on Mentorship Monday Live, just email us at helpme@derostergroup.com. That is helpme@derostergroup.com. And do not forget to smash that subscribe button. Justin Fraser, what are they going to get in this episode?
Today's episode was awesome. We break down the difference between JVs and LLCs, partnerships. How do you do it? How do you structure your deals? And stay tuned to the end to figure out Matt's best idea for how to invest across state lines and what Matt is going out to buy today so that he can do that.
JV, ABC, LLC, East Coast Family, 1, 2, 3. Let's do it.
Go.
Check it out, guys. What's going on, everybody? It's Matt Faircloth. Welcome to the Mentorship Monday program. I am here with my co-host of Mentorship Monday, Justin Fraser. Who do we got?
We have Mr. Dave Campbell. Dave, how are you today?
Doing well. Hey, Matt, Justin, thanks for having me on the show. I really appreciate it.
Thanks for
coming on.
Thank
you for being here. How can we brighten your day?
My question is basically, I'm getting to the point now, which is why I bought your book. And I love the book, by the way. Thank you. Raising Private Capital. Huge shout out. Great book. Because I'm going to be in that situation, I think, very soon, which I want to start to raise my own private capital to accelerate the real estate process. I think I've reached almost my limit of advance of where I'm at to be able to purchase properties on my own with my own capital. With that, I'm looking more of the actual tangible logistics of forming the partnership. You touch on JVs and you touch on formulation of an LLC. In which situations would you do each? And then sort of a broader question is, have you ever seen partnership form outside of those two? Just something unique that maybe I'm not thinking of.
Getting creative now, right? Okay. So I've done JV deals. I've done plenty of LLC deals, and I consider LLC deals to be like, we have partnerships with investors that are LLCs. We have LLPs, we have LP deals. They're all kind of the same, and I've discovered over the years, kind of doesn't matter, but LLC really is the one that's the most common. So discarding the LLP and the LP stuff as something different. The only other thing that you could do that I've heard of anyway, and people are more than welcome to, offer it up, right? Trusts, meaning like a trust with a beneficiary trustee kind of thing. I've not done that, and so I've never done a deal with a trust. And so I don't think I'm the right speaker on that. Okay. But I do know that exists. Justin, real quick, have you heard of other ways to structure deals with partners or investors that it's not an LLC, not a JV?
On the equity side, no. I mean, of course, there's debt options for partners, but not you're not going to bring them in necessarily on an equity side. LLCs, I would say, are the most common and probably the way to go.
And there's a lot of creativity you can bring into the LLC too, Dave. So it's not like the LLC really ties your hands. The operating agreement really opens you up to a blank slate. And there's all kinds of stuff you can talk about, right? Don't look at it as limiting, right? Because the LLC actually has a lot of beauty to it in that it's a pass-through entity, so you can pass through losses. There are other entities out there. Like you could do deals with a C Corp or something like that. But there's a reason why people don't do that. It's because it's not really structured for real estate deals. C Corps art and other types of company formats and stuff like that. So getting down to JV and LLC. What is a JV? A JV is a hybrid of a equity deal and a debt deal. A debt deal is where the lender lends you money. They're on one side of the transaction, you're on the other. An equity deal is where they're both sitting, they're riding sidecar with you in your deal alongside. And if you win, they win. If you lose, they lose. That is a equity deal and a debt deal. A JV is really where your lender, the person providing debt, becomes an equity partner of yours too. And they still are entitled to certain things that debt gives them. So maybe a monthly payment, maybe a flat, like a guaranteed minimum on a rate of return that they get, not a pref, but they still get a flat interest rate. And they typically they can be protected with a debt instrument or something like that. But on top of what their note payback is a chunk of your profit. Okay. That's a JV. Now, if you think about that, like, okay, so I'm going to debt with somebody, if you think about that's what a JV is, it starts to lend itself towards a short-term deal. You don't want to go and commit to debt and equity like that, like getting both of those obligations long-term into a deal. So the way that I've seen JVs work and the way that I've seen, like, hard money lenders are big on doing JVs. If you have proven yourself to them that you are a good borrower and they see upside and they love you or whatever, they will be all about doing JVs with you. But you'll rarely see them talking about doing long-term rentals because most JV people want out, right? They want to see an exit at some point. So JV deals work better for fix and flips, right?
Okay.
For adding value and then reaping that value out through a sale, and then you both part ways and move on down the road. A lot of reasons for that. It's tough tax return wise to continue to maintain that JV. If you're going to do it long-term, might as well just do an LLC. That's why JVs tend to work a little better on flips, right? LLCs are great for long-term holds. Short answer to your question is LLC, long-term hold, BRRRR strategy, value add, whatever it is you want to do. If you want to hold the property and have depreciation losses come through and have that trickle down to investors behind you and alongside you, LLC, that's what you want. We did a JV deal we built a bunch of townhouses with a JV and it worked out really well. Investor made a lot of money. We did really well too. So that's a JV that works because there's a beginning, middle, and an end. And it was like a 10-month cycle.
Okay. Just one follow-on question.
Please.
Let's go down the LLC route. So you're looking for
a
long-term partnership with a guy or, an entity, let's just say.
Or a gal, come on.
Or a gal, you're right. Guy, in person or persons. You're in one state.
Yeah.
This person's in another state. The named rental is in another state. I think you'd want to form the LLC in the state that the rental is at, but I just want confirmation on that.
Why?
Or is there some? Actually, I don't know.
You out, brother. I'm not. You thought you're on my quiz show now, right? So
yeah, right. Yeah. Well, so
why do you believe that?
Well, I think I'm just going off of nothing more than my own experience. I have an LLC in North Carolina, but I used to live in North Carolina, and so it was formed there because the properties were there. And I was there in this case, so I guess it's a little bit different of an example. So it just made the most sense. But so I guess
if it helps
maybe
you're right. So that is what you want to do.
I'm right, but I don't know why.
You got them all uncomfortable.
Right. All right, I have no idea. I don't know. Here's why. Here's why you want the LLC in the state that you're doing business, because the state you're doing business in is going to charge you. You're going to have to file a tax return because you made revenue in that state, right? So that's where the rental income came in. That's where the money was made. So you will owe a tax return in that state. Why would you set up an LLC in California while you also buy a property in North Carolina, or while you do business in another state? If you're not doing business and transacting commerce in the state the LLC is set up, that doesn't make sense to me. Again, hey, I should say now I'm not a CPA and not an attorney, but it seems to make sense to me. And my CPA told me that that's what we're supposed to do. So anyway, that's I believe that you should set the LLC up in the state where the property exists, and then where you are and where your investors are, that's secondary. Justin, what do you think?
Yeah, I'd say the only caveat to that is, you hear a lot of people talking about setting up in states that are tax friendly, Nevada or maybe Delaware. I think for a smaller scale, things like what you're doing, I take Matt's advice. Absolutely.
It's another reason people do Nevada, Wyoming, is because they're non-disclosure states. So if we owned an LLC and somebody decided to sue the LLC, there's no way of finding out who's behind it in those states.
Oh, I did not know that. Okay.
Yeah, it's not public record. It's like, none of your damn business kind of state, like who's behind this LLC. It's called piercing the corporate veil, meaning like getting through the company to get to whoever's standing behind it. You can do that a lot easier in other states. But you hear people doing these whacked out, I'm doing a Nevada C Corp and a Wyoming based, whatever, it's because the companies, those states don't disclose who controls and owns those companies very easily or at all.
That's really the only caveat. I think it makes sense to have an LLC where you're doing business. But if you have a LLC that has properties in multiple states, what then, right?
Yeah. Well, I've heard a strategy. We've only been in that boat one time, and it did not make me very happy because we had to pay multiple tax returns and stuff like that. The strategy I've heard then, let's say we've got Dave Campbell's awesome LLC that decides it's going to buy, a property in North Carolina and South Carolina. Okay. The way I've seen it done is you're going to have either a series LLC or a sub LLC that's going to own your North Carolina property, and then another property in South Carolina, another LLC in South Carolina that's going to own the property in South Carolina, and both those two LLCs flow up to a parent LLC that you own. That's maybe in one state or the other state. It's a pass-through entity, so it may still not work that way. I don't know. I talked to a CPA, but yeah, I think that for multi-state ownership like that, Justin, it probably gets a lot weirder and a lot more difficult.
Yeah.
I guess keeping it the cleanest would be having the LLC in each of the states. But if you really, really wanted to have it all nested under one LLC, there's a way to do it.
Yeah, I mean, it depends on your goals too. If you're going to have, one LLC and one property in 50 states, right? And you're going to have 50 LLCs to manage, that could be kind of tough.
Sounds like a good goal, right? I think I'll make a big ass mess.
It sounds like an operational nightmare.
That sounds like a big stinking mess right there. That's what that sounds like. Yeah.
Okay, maybe two or three areas.
Like you go to buy an RV just so you can go on the road to go look at your properties. That's it. You went on a road trip? No, you're running business.
Then wherever you go in the U.S., it's tax deductible.
There you go. Right.
Yeah, that's true. That's true. You're right.
So, Dave, great question. Just how to structure deals with investors is a core base question as you grow into real estate business and everything like that. And using the right entity, using the right structure is absolutely imperative to do it the right way. And to maximize profit for your investors, maximize decrease risk exposure for yourself. I mean, and that's why these things are out there.
Well, I appreciate it, gents. I mean, thank you for having me on, firstly, and then also thanks for the clarifying answer to the question. It definitely helped a lot as I move forward, and I think I'm going to be in this boat here pretty soon. So
great, Dave. Great to meet you.
You too. Thanks, guys. Appreciate it.
Thanks for watching, guys, and have a great and profitable week.